Can you imagine getting paid to take something home? It sounds like a crazy deal, right? Well, believe it or not, in 2020, something incredible happened in the oil market. The price of oil actually went negative. That's right. People were paid to buy oil. Imagine going to a gas station and being handed money just for filling up your tank. Well, this is not actually happening in your neighborhood gas station. It happened in future market in 2020. Today, we're going to dive into what happened and, more importantly, why it happened. To understand why oil prices dropped so dramatically, let's start with the basics of supply and demand. Picture this, a coffee shop in your neighborhood. If everyone suddenly stops buying coffee, but the shop keeps brewing more, they'll end up with too much coffee, right? And what happens to the price of coffee? It goes down because nobody wants to buy it. So to get rid of the extra coffee, they'd have to sell it at a discount or even give it away. Now imagine this happening on a much larger scale with oil. In early 2020, the COVID-19 pandemic led to global lockdowns. People were no longer commuting, airlines stopped flying, and factories around the world temporarily shut down. Suddenly, the demand for oil, usually one of the most in-demand commodities, plummeted. People just didn't need as much oil as before. This sudden drop in demand created a massive imbalance in the oil market, putting downward pressure on prices. But here's the twist. Even though oil demand was falling sharply, oil-producing countries didn't cut back on production right away. Oil-producing countries, often referred to as OPEC+, which includes major players like Saudi Arabia and Russia, couldn't reach an agreement on reducing output. Each country wanted to protect its market share and didn't want to be the first to cut back. So they kept pumping out oil as if nothing had changed. Imagine farmers harvesting way more vegetables than anyone can eat. If there's no one to buy them, those vegetables will just pile up and start to spoil. This is similar to what happened with oil. Too much supply, not enough demand. To make things even more complicated, the United States, which had become a major oil producer through shale oil, didn't cut back either. Shale oil companies kept operating and the oil kept flowing. So as the demand for oil went down, the supply kept going up, a recipe for trouble in any market. And this brings us to another key part of the story, the futures market. The futures market is where people buy and sell contracts to purchase or sell commodities like oil at a set price on a specific future date. These contracts, known as futures contracts, play a crucial role in stabilizing prices and helping businesses plan for the future. Think of a futures contract as a way of reserving a product in advance. Companies and traders agree to buy or sell oil at a certain price, regardless of what happens to the market in the meantime. For example, airlines use oil futures contracts to lock in the price of jet fuel months in advance, protecting themselves from unexpected price spikes. But futures aren't just used by companies that need the commodity. Many investors and traders buy and sell these contracts to try to profit from changes in oil prices. They may buy contracts when they think prices will go up and sell them when they think prices will go down, without ever intending to take physical possession of the oil. This speculative activity helps keep the market liquid, meaning there are always buyers and sellers, which generally stabilizes prices. However, it can also lead to volatility, as we'll see. There's also an interesting history to futures trading. The futures market originated centuries ago when farmers and merchants wanted a way to stabilize prices for crops. By agreeing on a set price in advance, they could avoid sudden losses from poor harvests or market crashes. Fast forward to today, and this market has grown into a massive global network, dealing with everything from crops and livestock to energy and even financial products. This history helps illustrate why futures exist, not to make markets more complicated, but to bring predictability to an unpredictable world. Now here's where things get really tricky. Unlike coffee or vegetables, oil isn't something you can just leave sitting around. It has to be stored carefully, usually in huge tanks or specialized facilities that become part of what we call oil reserves. But with so much extra oil being produced, storage facilities around the world were filling up fast. In the United States, there's a major oil storage hub in a place called Cushing, Oklahoma. It's like the country's oil warehouse. By April 2020, it was almost completely full. Imagine trying to fit a month's worth of groceries into a tiny fridge. Eventually, you're going to run out of space and things will start spilling over. This lack of storage space made the situation even more urgent. With nowhere to put the extra oil, something had to give. And this is where the futures market came into play again. Let's say you're holding a futures contract for oil. When that contract expires, you don't just get a piece of paper, you're expected to take delivery of actual barrels of oil. This is called physical delivery. In normal times, this isn't a problem because buyers can store or use the oil as needed. But in April 2020, nobody wanted to take that oil because there was nowhere to store it. Holding on to the contract meant you'd have to find a place to put that oil, which was both very expensive and incredibly hard to do. As the expiration date for the oil contracts approached, everyone who held these contracts was desperate to sell them. Traders who had bought contracts hoping to sell them at a profit now found themselves in a bind. They didn't want the oil itself, and they certainly didn't want to pay for storage, so they scrambled to find someone, anyone, who would take these contracts off their hands. But with storage facilities full and no one willing to take on the cost and logistics of storing the oil, prices began to plummet quickly. And then something unprecedented happened. The price went negative, dropping all the way to 30 cents or 63 per barrel. Yes, you heard that right. Sellers were actually paying buyers to take the oil off their hands. It's as if you had too much food in your fridge that was about to spoil, and you started paying your neighbor to take some of it, just so it wouldn't go to waste. This historic drop to negative oil prices shocked the world and highlighted the unique pressures in the oil market that had been building up for weeks. It also showcased the complex dynamics of the futures market, where contracts can change hands multiple times before the product is finally delivered. When too many people want to sell at once and no one wants to buy, prices can collapse, even to negative levels. To recap, the price of oil went negative because of a perfect storm of events. First, there was a sudden drop in demand caused by the COVID-19 pandemic. Then, oil production continued, leading to a massive oversupply. Next, storage space started running out, putting pressure on everyone holding oil contracts. And finally, the futures market forced people to either take the oil physically or pay someone else to take it. The result? A negative oil price, something that had never happened before. The futures market, while sometimes volatile, is an essential tool that allows businesses to manage risk and prepare for the future. It's a marketplace that brings together producers, consumers, and investors who each play a role in setting prices, stabilizing supply, and keeping the global economy moving. While it may seem complex at its core, the futures market exists to bring stability to an uncertain world by helping everyone from airlines to energy companies and even regular consumers navigate the ups and downs of commodity prices. This event showed us just how interconnected the global economy is. It also highlighted how quickly things can spiral out of control when supply and demand are out of balance. So the next time you see oil prices changing, remember that it's more than just a number. It reflects a complex web of global trade, supply, demand, and the constant balancing act in a highly dynamic market.